Shares in Domino Pizza were hit hard today as it announced a significant shake-up, including the closure of its Denmark business and between 65 and 70 underperforming corporate-owned stores.
Prepare to witness the seismic collapse of an industry giant. In an unprecedented move with its global empire, Domino's Pizza is on the brink of a catastrophic shutdown. As the retail meltdown rages on, the once unstoppable Domino's faces an uncertain future. Brace yourself for the shocking details of this epic downfall. In the ever-changing landscape of the restaurant industry, the largest chains in America find themselves grappling with unforeseen challenges as the economy continues to lose steam. The repercussions of this economic slowdown are far-reaching, and even industry giants like Domino's Pizza are feeling the heat in the year 2023. With an impressive network of nearly 19,000 stores worldwide, Domino's Pizza has long been synonymous with convenience, speed, and mouth-watering pizzas. However, recent events have shocked the company and its loyal customer base. Controversies surrounding price hikes have marred the once pristine image of this iconic chain, leaving consumers disgruntled and seeking alternative dining options. As the storm clouds loom overhead, Domino's Pizza has to make difficult decisions. Thousands of underperforming locations are being forced to close their doors, marking a stark departure from the chain's once expansive footprint. These closures acknowledge the harsh reality that domestic and international sales have taken a deep plunge. The chain's once towering shares have plummeted to their lowest levels in over a decade, causing alarm among investors and industry analysts alike. The troubling data emerging from Domino's Pizza paints a grim picture of a company teetering on the edge of a precipice. Experts warn that the magnitude of its troubles may far surpass initial estimations. The consequences could be catastrophic if the chain fails to swiftly address its problems amid an intensifying economic downturn. The mounting debt threatens to engulf the once thriving pizza empire, potentially catapulting it into the abyss of the great retail collapse. The fate of Domino's Pizza hangs in the balance, leaving investors and consumers on tenterhooks. Will this industry stalwart summon the resilience and ingenuity necessary to reinvent itself and emerge triumphant from the storm? Or will it succumb to the relentless forces that threaten to dismantle its existence? In these uncertain times, reflecting on the broader implications of Domino's Pizza's struggles becomes crucial. Its tale services as a cautionary reminder of the fragility inherent in the restaurant industry, where even the most established brands can face unexpected downturns. The domino effect of such setbacks extends far beyond the company's bottom line, impacting employees, suppliers, and the overall economy. Moreover, Domino's Pizza's predicament raises intriguing questions about the evolving dynamics of consumer preferences. Has the price hike controversy exposed deeper underlying issues within the company, or does it signify a shift in consumer behaviour towards more affordable and locally sourced dining options? Are consumers demanding more than just convenience and speed, placing greater emphasis on ethical and sustainable practices? Industry players must adapt and evolve to survive as the restaurant landscape continues to undergo seismic shifts. Innovation and agility becomes the lifeblood of success, allowing brands to stay ahead of the curve and resonate with ever-changing consumer demands. For Domino's Pizza, the path to redemption lies in its ability to reinvent itself, rebuild trust, and deliver an experience that aligns with its audience's shifting values and expectations. In October 2022, Domino's Pizza executives decided to implement a 7% price hike across their menu. Little did they anticipate the profound impact this seemingly minor adjustment would have on the company's fortunes. The move backfired spectacularly, driving many loyal customers away and pushing them towards the alternative of cooking meals at home. As a result, Domino's found themselves grappling with sinking sales and growing dissatisfaction among its once loyal fanbase. As industry experts analyse the situation, it becomes apparent that Domino's pricing strategy lacked efficiency and failed to consider the changing habits of consumers in a post-pandemic world. Compared to pre-pandemic levels, the chain's prices remained a staggering 12% higher. This discrepancy created a jarring contrast, with customers feeling the pinch in their wallets and opting for more cost-effective alternatives. The repercussions of Domino's ill-fated pricing decisions reverberated throughout the country. Sales dipped across various locations, highlighting the widespread dissatisfaction among American consumers. The issue's root lay partly in Domino's decision to target some of its most popular deals with higher prices. For instance, the beloved Mix and Match deal, which previously stood at $5.99, suddenly increased to $6.99 in December. This change further alienated customers who had come to rely on such deals for affordable and satisfying meals. Moreover, Domino's made key alterations to its renowned Carry-Out deal, which previously provided customers with a pizza dip and bread combo or wings for $7.99. While the deal's price remained unchanged, the company reduced the number of wings, included downsizing from 10 to 8. Additionally, Domino's limited the Carry-Out deal to only customers to choose one topping on their pizza compared to the previous option of 3 toppings. To compound matters, the chain restricted the deal to digital-only orders, excluding those who preferred to order in person or over the phone. Unsurprisingly, these changes left customers dissatisfied and disenchanted with the once-beloved pizza chain. The alterations to the Carry-Out deal felt like a reduction in value, as customers received fewer wings and had limited options of pizza customization. Furthermore, the shift to digital-only ordering excluded many customers who preferred traditional ordering methods. The question that arises from this tumultuous situation is whether Domino's Pizza underestimated the impact of its pricing decisions and the importance of customer satisfaction. Did the chain prioritize short-term profit gains over long-term customer loyalty? As consumers increasingly seek value for their money and alternatives to dining out, Domino's must grapple with these repercussions and evaluate its strategies moving forward. In a stunning turn of events, the renowned Domino's Pizza chain grapples with myriad obstacles that threaten its very existence. From a drastic decline in demand for its signature pies to persistent delivery woes, the Michigan-based company is caught in a whirlwind of troubles that have sent shockwaves through the industry. One of the major setbacks plaguing Domino's is the ill-fated changes made to its once popular $7.99 carry-out deal. As consumers grow increasingly price-sensitive, it appears that few are willing to pay regular pizza prices, resulting in a significant blow to the company's sales. The popular pizza chain Domino's is currently facing challenges in delivering their products to customers as they are struggling with a shortage of drivers. This unfortunate situation has resulted in a significant impact on their profits. In order to stay competitive with the rising cost of delivery fees and the emergence of popular third-party delivery options such as Grubhub and DoorDash, they must prioritize improving their service quality and value offerings. This issue is of great concern to the entire food industry, and, if left unresolved, could potentially indicate larger problems stemming from economic pressures. To compound matters further, Domino's has encountered setbacks in its attempts to innovate and adapt. Recent delivery projects have proven to be an expensive failure. Despite these efforts, sales have stagnated and talent shortages persist. Domino's sales have dropped 6.6%, leading to concerns about profitability and a significant sell-off. The company has $5 billion in debt, much higher than its cash reserves of $165 million. This raises concerns about sustainability, especially with rising interest rates and a potential recession. The company's stock buyback programs and high dividend payout have also added to the financial strain. Expenses now outweigh revenues. Beyond the borders of the United States, Domino's faces additional challenges. In Australia, the brand has suffered a significant loss of market value due to a slowdown in home delivery orders. The country's ongoing cost of living crisis has impacted consumer behaviour, leading to a decline in pizza consumption. Similarly, in Denmark, the decision to shutter all Domino's stores reflects the company's acknowledgement that the losses incurred outweigh the growth potential. With Europe experiencing declining sales and inflationary pressures, Domino's has struggled to find effective strategies to combat these challenges. Increased product prices and delivery surcharge fees have deterred customers from ordering as frequently, further impacting the company's revenue. In a shocking development, the Italian franchise operator of Domino's Pizza has filed for bankruptcy, resulting in the closure of all of its locations in the country. The company attributed this unfortunate outcome to rival food delivery services' increased popularity during pandemic lockdowns, making it financially unsustainable for Domino's to compete. Even in the United States, Domino's Pizza faces challenges and losing market share to competitors like Pizza Hut and Papa John's, who have adapted to changing consumer preferences and leveraged third-party delivery partnerships. The company's failure to evolve and respond to market dynamics has left it vulnerable. With mounting debt and concerns about profitability, Domino's Pizza must quickly devise strategies to regain stability. As the retail industry continues to experience upheaval, the fate of Domino's Pizza raises questions about how major players in the food service sector will adapt and survive in an era of intense competition. The company's future hangs in the balance as it grapples with the need to reinvent itself or risk fading into obscurity. In the wake of Domino's Pizza's staggering struggles, the future of this once mighty chain hangs by a thread. As thousands of stores face closure, the domino effect of the retail meltdown looms large. Will Domino's find a way to rise from the ashes, or is this the beginning of the end? Let me know your opinions in the comment box. Stay tuned for more updates on the fate of Domino's Pizza. Don't forget to share and subscribe for the latest developments in the retail industry's gripping saga.